Hi everybody, this is Greg Gossett from Gossett Trading and Mentoring, and today is Saturday, July 11th, 2026. Hey, how you doing? I hope you're having a nice weekend. I hope you had a good trading week last week, and I appreciate you coming to my weekend review podcast. I hope you were going to find it helpful today. The format for the podcast today is, first of all, we're going to run the U.S. legal disclaimer. Secondly, we're going to come back and we're going to take a look at all the trades and positions that I have and that I made from last week. We're going to talk about when I entered the trades, why I entered the trades, what the setups were, what the confluences of signals were, how I'm going to position size correctly based upon the market's current volatility, how I'm going to place my emergency stop, how I'm going to place my end of bar stop, how I'm going to take partial profits if the market moves in the direction that I want it to, what I'm going to do when I get to trailing stop level, and then ultimately how I'm going to exit the trade if it goes up to extreme overbought levels. So we're going to talk about when I entered the trade, why I entered the trade, and really most importantly, how I am going to manage these trades going forward. Like I said, I hope you're going to find that helpful and it's a value, give you some value. And if it is, I appreciate if you could hit the thumbs up button. It really does help out the channel and lets YouTube know that there's some valuable content here so they can share it with more people. After that, we are going to talk a little bit about trader psychology. The most important skill in trading is the ability to create a plan and to follow the plan. There are a lot of good trading plans out there, all sorts of different ones. You have to kind of find the one that fits your personality, but regardless of what the plan is, it does no good if you don't follow the plan. There's so many people in trading that would have made money or made more money if they just would have followed their plan, but our emotions get in the way. We read some news, we think something's going to happen, and we kind of break our plan. And more times than not, in my experience in over 30 years of trading, it goes against us. So it's super important to get yourself a plan, but more importantly, to follow that plan. And that's why I like to talk about trader psychology. I hope that it will help you, will resonate you, and will help improve your trading. After that, I have gone down through my master watch list. I do that every Friday night. I go down through every stock in the watch list and I look for potential trades for the upcoming week. I'm looking for areas and confluences of moving averages, order blocks, RSI levels, double bottom bullish MACD divergences, and I'm looking for those to align. I'm looking for more than one. I'm looking for a combination or confluence. And I've got some good ones. I have 7 of them that I'll be going over later in the podcast, that they're not there yet. They're not where they need to be yet, but they're getting close. They're getting within striking distance. And if they do get to those levels and reject those levels, then I will potentially think about getting in the trade. So I'll be sharing all those with you as well. So anyway, again, thanks for coming to the podcast today. And I'm going to run this U.S. legal disclaimer, get this out of the way, and then we'll get started. So hang tight, please.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and/or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much.
All right, thanks for holding through that with me, and let's get started on the first daily open position that I have. This is Walmart, WMT. So I did enter Walmart here on the 2nd of July at 111.81. Now this is a combination. Remember, ideally I look for combinations of setups. This is a combination of a rejection of a major moving average, which is the 300-day moving average. This is a deep dip buy entry strategy. But the confluence is that it happened in an order block, and order blocks, probably more than, I guess 85% of the trades that I take have to do with an order block. So this order block was formed in the past, this green box. So let's go back to the past, and this one's quite a long time ago. But this order block happened here on the 8th of January. So these order blocks tend, in my experience, to have memory. So if I create an order block in the past, if in the future it comes back to that order block, there's generally a reaction there. Not all the time, but more times than not. So let's first talk about what an order block is. So the pattern for an order block is I first need to find a swing low. And here, this is a swing low on the 2nd of January. 2nd of January. So a swing low is simply a low that has a higher low to the left and a higher low to the right. So you can see this is a swing low, higher low to the left, higher low to the right. After that swing low, I need a swing high. Now a swing high is just the opposite. It's a high with a lower high to the left and a lower high to the right. So far we have two of what we need. We have a swing low and we have a swing high. Now the next thing I need is another swing low that is lower than the first swing low. And here it is. This is the swing low because it has a higher low to the left and a higher low to the right, and it is lower than the first. So we have a swing low, we have a swing high, and we have a lower swing low. Now, when we have that in place, the important level, we have to refer back to the first swing high. Remember how we had the swing low, we had the swing high, we had the lower swing low. If in the future price moves up above that first swing high, as it did here on this bar here, the very next one, it took out that swing high. Now we have defined the order block. And when you have the swing low, you have the swing high, you have the lower swing low, and then you take out the swing high, you're breaking market structure to the upside. And the second you break market structure to the upside, the lowest closing bar prior to the market structure change defines your order block. So I take the high and the low of this bar and I move it into the future. Now, this is a very good example on Walmart of changing market structure. And was the market structure correct? Yeah, it sure was. But, let me refer you up to these highs up here. So when I look at these highs, and then I look back to the breaking the market structure, and I look back to the order block area, can I safely say, now that we know it's up here, that smart money was buying this area? And yeah, of course, I think that's a very safe assumption to make because we went from here all the way up to here. So, these are called order blocks, but I really like to call them smart money area. Clearly, when the price got up here and you refer back to where the order block was formed, yeah, clearly smart money was buying here because it rallied significantly. So I look at this order block as smart money. Now, it was smart money back here. If it comes back down here again, will it be smart money again? And the answer is not for sure. I mean, things can change. Just because it was smart money here doesn't mean in the future it's going to be smart money if it comes down to there. But the point is, it is more often than not. So essentially, order blocks are just structure changes to the upside that define the order block. And then I'm waiting for price to come back down to an area that once was smart money, and we'll see if it's smart money again. Okay, so I hope that makes sense. So just going to bring this into the future. And so I was waiting for Walmart to come back to the smart money area. And back in June, it did. It had that sell-off, came all the way back to the smart money area, and then it bounced pretty nicely. But then we had this other leg down. I took the trade here on the 2nd of July, for two reasons. One, the day before I entered, we closed below the order block, and then we closed above the order block. So that by itself is a signal. If you close below the order block and then close back in the order block, that by itself is a signal. But in addition to that, we also, back to the deep dip buy strategy, the 300-day moving average, this is my line in the sand now on this trade. So the previous day we went under the order block, we closed back in it. In addition, on the day that I took it, we closed back over the 300. That by itself was a legitimate signal. The close under the 300, over the 300 is a legitimate signal just by itself. But what makes this trade even better is that we had the confluence of a rejection of the bottom of the order block and a close back in the order block, which by itself is legit. But at the same time, we had the close under the 300 and then close over the 300. Another signal, two primary signals. In addition to that, another deep dip buy signal. The previous day we closed under the 30 RSI. We closed over the 30 RSI. These are three primary signals. And so in addition to that, if you notice this kind of thick gray line here, this is the negative third ATR channel. Now, this is not a primary signal, but it's a secondary signal. And whenever you close under the negative third and close over the negative third, or intraday reject the negative third, like I said, not a primary signal, but a secondary signal, definitely gives added bonus points to the trade. So all in all, this is a very, very good setup. In addition, I talked about double bottoms, bullish divergences. If we look at this bottom here, you can measure the depth of the MACD bars very deep. Then we rally into some green bars. Now we come lower. We're lower here than we were in that first low, but the MACD bars are not as deep. This is also a very important technical signal. Really, when this happens and you have this MACD divergence, it means that this second leg down here from the MACD perspective does not have the momentum that the first move down had, because the bars aren't as deep, and it's indicating you're running out of selling momentum. The implication is if you're running out of selling momentum, you're running out of sellers, and if you're running out of sellers, you could look, you could foresee a potential bounce happening. So all in all, this is a very high level, lots of signals entry, and that's why I took it. So I took it here on the 2nd of January at 111.81. So now that I see the signal and I decide that I'm going to enter the trade, the first thing I have to decide is how many shares am I going to buy? And this is probably your most important decision on any trade. And I have a very simple formula that has worked well for me, and I'll just share it with you. It's very simple. The first thing I need to know is how much is in my trading account. Let's just say I have $100,000. I simply take 1% of my total trading account. 1% of 100,000 is $1,000. This is going to be my maximum allowed loss on this trade. If everything goes south, this will likely be my worst case scenario. There are times where it can be more than this, but most of the time, this is going to be my maximum allowed loss. So I take 1% of my account. 1% of 100,000 is 1,000. If I had a $200,000 account, 1% would be 2,000, and so forth. $50,000 account would be 500. 100,000, 1% is $1,000. Then I look to the value of the 2 ATR. The value of the 2 ATR is going to tell me what the volatility of the market is. If the volatility is very high, this number will be larger. If it's low, it will be smaller. And so I take that 1% of my total trading account as my maximum loss, $1,000 in this case, divided by the value of the 2 ATR on the day that I take the trade. And magic presto, it shows me how many shares to buy. 180.83. So I'm just going to round that up to $181. That's it. Now I am perfectly position sized based upon my decision that I can lose 1% of my total trading account And I've also factored in the volatility of the market. So I've done what I could do, right? Now, some people use 2% maximum loss. Some people use 3% maximum loss. Some people use a 0.5% maximum loss. But for me, 1% maximum loss is about right. So, okay, we had the rejection of the bottom of the order block. We had the close under, close over 30 RSI. We had the close under, close over the 300-day moving average. We also had the rejection of the negative third ATR. That's why I decided to take the trade. I bought 181 shares here at 111.81. Now, as soon as I do that, the very first thing I need to do is I need to refer back to the 2 ATR value, the one that I just used in the math to find out how many shares I wanted to buy. I simply take my entry price, the dotted line here is my entry price, and I minus the value of the 2 ATR, and I put a thick red line below it. This is my emergency stop. This is $5.53 below my entry. If I have the amount of shares that I just have and it moves down 5.5, well, let's just do the math, sorry. $1,000 maximum loss divided by 553, yeah, 181 shares. If I have 181 shares and it moves down $5.53 to my emergency stop, how much have I lost? $1,000, because we already did the math, right? So the good news, the bad news is if it moves down here, you lose 1% of your account, which is never fun. However, if you lose 1% of your account, it's not the end of the world. You can recover from this. That's the bad news, is that you will lose 1% of your account. The good news is that hitting your emergency stop only happens about 5% of the time. The other 95% of the time, if I have a losing trade, it is not going to be because it got to my emergency stop. It happens very infrequently. It will be because I had a close below my end of bar stop. And my end of bar stop is always going to be much closer to my entry price than the emergency stop. So we have to look here and say, okay, what is my end of bar stop? Well, my end of bar stop on this trade is a close below the 300-day moving average and close. You can see the next day it went below, but I don't make decisions based upon the price during the day. I wait for the end of the day to make my decisions. And, at the end of the day, you have the large financial institutions come in. They are dealing with the most money. They have very smart people. They have the best information. They have the best technology, and they tend to move the market towards the end of the day. So in my opinion, the closing price of the day is the most valid price of the day to make your buying and selling decisions from. And so I wait for the end of the day. So I have my signals. I did my position sizing. My emergency stop is 2 ATRs below. My end of bar stop is simply a close below this 300-day moving average. Okay, the next thing that I do, once I enter and I have my stops all in place and I have my plan, I take my entry price and now I look to the value of the 1.5 ATR. The value of the 1.5 ATR right at this moment is $4.15. I simply take my entry price plus the value of the 1.5 ATR, I add them together, and I put an orange line above. This is now my trailing stop mode. This means that if the market that I'm trading moves up to that 1.5 ATR trailing stop level, now I go into what is called trailing stop mode. And in trading in general, if you enter a trade and it starts to move in the direction that you want it to, then you should start to tighten up your stops. And this is just proper trading. If it really starts to move up, you want to kind of tighten up your stops so you don't give all of the profits back. And that's exactly what trailing stop mode does for me. So if in the future it gets to trailing stop mode, it doesn't mean I do anything once it reaches that. It just means now in the future, if I have a close below a previous bar's low, I'm going to exit half of my position. And by doing that, that has the effect of moving all my hard stops up. right? And that's correct trading. Some people actually move their stops up. I don't. I leave my stops in place by selling half of my position. It has the same effect of moving everything up, right? So, all right. So you can see this trade is not yet to trailing stop mode. So if I have a close below previous bar's low at this point, I will not take any action. So everything I've talked about so far, as far as the emergency stop, the end of bar stop, going into trailing stop mode, these are all defensive moves. In other words, if the market moves against me in some sort of fashion, I have to take action. But I don't like to just play defense with my trading. I also like to play offense in my trading. And so the way that I do this is that I take partial profits each day if the price moves a certain distance from the previous day's close. So it's a very simple formula. I've used this for years. It works very, very well. I don't sell all of it. I just sell a portion. But just let me show you exactly what I'm going to do for Walmart on Wednesday. I simply take the closing price. Right now it's $113.90. And I add to it the value of the 0.45 ATR. Right now the value of the 0.45 ATR is $1.24. Closing price plus $1.24. I have my first profit target for Monday. It is 115.14. So I'll just mark it up there. 115.14. There it is. If Monday it gets to that point, I will have an order in the system to take out 10% of however many shares I go into the day with. If I go into the day with 100 shares, I'll put an order in to sell 10 at that level. Now, I don't just place one, I place three. So I showed you how to do the first profit target, closing price plus the value of the 0.45 ATR. 113.90 plus $1.24 is 115.40. That's our first profit target. Now I simply take the first profit target, 115.14, and I add the value of the 0.45 again. My second profit target for Monday only is 116.38. There you go. And if it gets there on Monday, if it also gets there, I'll sell another 10% of however many shares I have there. And then I do it one more time. I take the second profit target, which is 116.38. Again, add the 0.45. My third profit target for Monday only is 117.62. And there you go. Those are my three profit targets. So if it goes up decently on Monday, yes, maybe I'll take 10% off of however many shares I went in the day. If I have a really good day, maybe hit two. If I have a fantastic day, maybe I hit all three. And by doing that, if I were to hit three on Monday, I mean, obviously I'm locking in profits that the market can't take it away from me. I'm reducing my position size, which I think is a good thing. Reducing your position size into strength, because with reduced position size, you have fewer shares, there's less stress. It's more likely that you're going to follow your trading plan. So really, I'm a huge fan of taking partial profits. And the other advantage too is if you hit some profit targets to the upside, but then you have big reversal in the stock, well, you've locked in profits that the market can't take it away from you. You have fewer shares. And if it does reverse, then you have fewer shares, so it mitigates your loss. Make sense? So, okay, that's pretty much the setup of Walmart. So let's just now go through, and in the other trades I'm going to go through, I'll go through much faster than this one. I just kind of wanted to set the stage here with Walmart. So again, entered Walmart 111.18 on July 2nd. Why? Rejection of the bottom of the order block, rejection of the 300-day moving average, rejection of the 30 RSI. I entered 111.81. I placed my emergency stop 2 ATRs below. My end of bar stop is simply a close below the 300-day moving average. I placed my 1.5 ATR trailing stop level above, and off we go. Next day, started off down, or went down, closed down, but it did close above my line in the sand. That end bar stop there of the 300 kept me in the trade. The next day, gapped up, which was nice because it gapped up into a profit target. Next day, up again, hit a profit target. Next day down, no profit targets. And then on Friday, was up again, sold another profit target into that strength. So, hasn't moved a lot. It's definitely profitable so far. So far from entry with the remaining shares I have, up pretty good. I mean, it's up 1.91%. And as we move forward, if we close below that 300-day moving average, I'm out. If it continues to move up, I'll continue to take partial profits. If it hits to the orange line, I don't do anything. It's just that now I'm in trailing stop mode. And in the future, if I have a close below a previous bar's low, I'm going to exit half. So the remaining shares so far on this trade on Walmart up 1.91%. All right, CRM. CRM's been a pretty good trade so far. I did enter CRM back here on the on the 25th of June. Why? Well, let me bring your attention. This was for teaching. Just clear this up a little bit. Let's do some teaching examples there. So this particular trade I entered here on the 25th of June at 150.10. So why? Well, it all has to do with this blue box. This blue box is an abandoned baby. Strange name, but an abandoned baby consists of 3 bars. And here's bar 1. From bar 1 to bar 2, you see we gapped down. Okay, so overnight we had a bearish sentiment in the stock. However, the very next day it gapped up, and just basically when you have a gap down immediately followed by a gap up, in my experience, more times than not in the future, you are going to be higher because you have a sudden shift of sentiment from bearish to bullish. So what I just showed you on Walmart, almost all the trades that I have, I use the going into trailing stop mode, taking partial profit, so forth and so on, like I just showed you. But there is an exception when it comes to abandoned babies or island reversals, where I make it a much more simple trade, where I basically have a 2 ATR stop below me, and I have a 4 ATR profit target above me. And for sure, one of two things is going to happen. I am either going to hit my 2 ATR stop, in which case I lose 1%, or I'm going to hit my 4 ATR profit target, in which case I make 2%. So I don't just automatically, when we have an abandoned baby, just enter. I usually wait for the abandoned baby to form and then have some kind of pullback to try to optimize my entry. So we had the abandoned baby here. I did enter the trade here on the 25th of June because at that day, two things happened. We bounced right at the 30 RSI and we rejected the negative third ATR channel, and this all happened within the body of the abandoned baby. So at this point, I entered 150.10. And again, on this particular strategy, I have a 2 ATR stop. And if I hit that, I'm going to lose 1%. But to the upside, I place a 4 ATR profit target. If I hit that, I'm going to make 2%. So I'm risking 1% to make 2% on a setup that I know more times than not will hit my 4 ATR profit target instead of hitting my 2 ATR stop. And I just let it go. Right? So you can see it started off pretty nicely and then it moved back. So this particular trade from entry is currently up 8.12%, but I'm not doing anything with it. I'm just letting it play out until it either hits my 2 ATR stop or my 4 ATR profit target. But so far, so good, up 8.12%. Microsoft. All right, I entered Microsoft here on the 26th of June at 373 even. Why? Well, you can see we have an order block, the green box. Previous day we closed under it. Next day we closed back in it. That by itself is a legitimate entry. We also, previous day, closed below 30 RSI. Next day closed above it. So there's the confluence, rejection of the bottom of the order block, plus a close under, close over the 30 RSI, which is a deep dip buy signal. In addition to that, previous day we closed under the negative third ATR channel. Next day we closed above it. In addition to that, we had a V2 pattern. V2 patterns consist of 3 bars, bar 1, bar 2, bar 3. Bar 2 goes under bar 1's low. Bar 3 closes at bar 1's close. So nice confluence of primary and secondary signals. So I entered here 373. I position sized as always. Put my emergency stop down here for a maximum 1% loss. My end of bar stop on this trade is simply a close below the low of the order block. I placed my 1.5 ATR trailing stop level above. Next day gapped up a little and then reversed. Next day up a little, not enough for a profit target. Next day moved up nicely, hit a profit target. Next day here, can't remember if I hit a profit target. I don't think so. Next day down a little. Next day gapped up nicely where I did hit a partial profit target, and I also got to trailing stop mode. Doesn't mean I do anything. It just means because I did touch the trailing stop mode, now I breached that threshold. Now in the future, if I have a close below a previous bar's low, I'm going to sell half, and that happened the very next day. You can see we did close below a previous bar's low. After reaching trailing stop level, what do? I took off half of my position, which has the same effect of just moving all of my stops up. So I locked in a gain of 2.75% on Microsoft. Next day, we gapped down, but reversed, kept us in the trade. Friday, at the top before it reversed, I also took a profit target off there. So I locked in half, took off half for a gain of 2.75%. And then the remaining shares that I have at the moment are up 3.14%. So not too bad, really nice signal, and so far is working out. But again, combination of a deep dip buy signal under 30 over 30, and in addition, a close under, close over the order block, or in other words, close under the smart money area and close back in. So remaining shares up 3.14%. Apple's been a tremendous trade, really fantastic trade. So I entered Apple back here on the 29th of June. Why? Well, several reasons, actually. Okay, the first is this green order block. There's an order block from the past, smart money area. I was waiting for the price to come back into the order block. I could have bought it here on the 25th. You see how we rejected the bottom of the order block? Nailed it. The smart money area was correct again, but I didn't buy it there. The next day it closed back above the order block. I could have bought it there as well. But I did buy it here on the 29th because it again tested the top of the order block and closed above it. But the real key to taking this trade is this trend line here, this megaphone trend line. A megaphone trend line is simply when you take a swing low and you connect it to a lower swing low. So you can see this is a swing low, this is a swing low. We move the trend line into the future. Usually at that third touch of the trend line, this is the first, this is the second, this is the third. Usually a rejection of the third point on the trend line can indicate that maybe you're going to have a bounce. So the day before, it did close above the trend line. I could have taken the trade, but I didn't. But when it retested this trend line, closed above it, retested the top of the order block, closed back above it, that is where I decided to take my entry. And I entered at 281.61. So I position sized, I placed my emergency stop 2 ATRs below, but now I have to decide what is my end of bar stop. So in this particular trade, I created my own custom end of bar stop. I could have used the 100-day moving average, the red line. That would have been fine. But I based my end of bar stop on the previous, the day before I entered here on the 26th. You see how we have this big up bar? Whenever you have a big up bar, the midway point, the halfway point of that bar generally has some inherent support. So you can see the green line I placed here was halfway of this big up bar. So this is essentially my end of bar stop right here. And if I'm doing my job right, my end of bar stop is going to be pretty close to my entry so that if I'm wrong, I can be wrong the smallest amount. So basically, that's what happened. Rejection at the top of the order block, rejection of that third point on the megaphone trend line. I position size, I placed my emergency stop 2 ATRs below, and then my end of bar stop was a custom one. It was halfway of the previous day's big up bar. In other words, if it would have closed here below 278.90, I simply would have gotten out of the trade. I placed my 1.5 ATR trailing stop level above, and the next day took right off, which was great. Hit multiple profit targets into that strength. Next day up again, sold into that strength. Next day, huge up bar where I hit, I think, 3 profit targets on this move up. And next day was up again, another profit target. So now we have moved up significantly. And at this point, we have got to the 65 RSI level. And so this is just another one of my rules. If I get to a 65 RSI level, now this 5 EMA comes into play, this thin blue line here. So if I get to 65 RSI or higher, and then I close below the 5 EMA, that's the end of the trade. So you can see a couple days ago, we tested underneath, but closed back above the 5. On Thursday, we certainly went below, closed back above the 5. On Friday, we got right to it again, closed above, that kept me in the trade. So very simple. Going forward, if the price closes below that 5 EMA, that will be the end of the trade for me. But so far, this trade is doing very, very nicely, really up 10.66% from entry. And, this is just a good example in trading because this is really what, for me at least, what trading is really about is looking for rejection of key levels, knowing what your worst case scenario is going to be and your emergency stop, and then having your end of bar stop as close as you can to your entry so that if you're wrong, okay, I was wrong, I lost a little, it's okay. But the whole idea of trading is to risk a little to make a lot. And this is exactly what happens. So the remaining shares on Apple here up 10.66%. Boy, I have a lot of positions. All right. Well, so far we have talked about the green box being the bullish area to buy. However, there are red boxes, and a red box is a bearish order block. And you can see the red box here is the bearish order block. So a bearish order block is just the opposite of a bullish order block. Instead of starting with a swing low and then a swing high and then a lower swing low, it's the opposite. You start with the swing high, you have a swing low, you have a higher swing high, and then you have a big move down that takes out that swing low that changes the market structure from bullish to bearish. Once it's bearish, I am waiting for the markets to move back up or check back into the bearish order block, which is the highest closing bar before market structure change. And this was the highest closing bar before market structure change. And so when it rallied back into the bearish order block, I was looking for a short entry. I took the short entry here on the 22nd of June at 737.33. Why this entry? Because two reasons. We rejected the bottom of the bearish order block, meaning we were in it and we closed back below it. In addition to that, we have a V1, a bearish V1. A V1 consists of two bars, bar 1, bar 2. Bar 2 goes above bar 1's high, closes back below bar 1's close, okay? So that's why I entered the trade. The bearish V1, the rejection of the bottom of the order block, I shorted at 737.33. I placed, because I'm short, I placed my emergency stop 2 ATRs above. My end of bar stop on this trade is simply a close above 739.70, because 739.70 is the halfway bar of the V1. And by the way, if you'd like to learn more, excuse me, if you'd like to learn more about V1s and V2s, just go to my YouTube channel. I have a video there. I explain in detail V1s and V2s. But when you have a V1, that second bar, a close back above that halfway of that second bar is my end of bar stop. And you can see how close I was. My entry is 737. My end of bar stop 739, so I had a very small risk to the upside. So I got short here, 737. End of bar stop, close above halfway the washout bar, 739.70. Of course, I have my emergency stop 2 ATRs above, and because I'm short, I put my trailing stop level 1.5 ATRs below. The next day, really nailed this trade. Next day, gapped way down. So I hit multiple profit targets into that strength. In addition to that, I'm also in trailing stop mode. Next day continued down further where I took more partial profits to the downside. Next day we had a huge gap up, but it did not close above the previous bar's close, kept me short in the trade, or kept me in the full short position. Next day down again where I took more profit targets. Next day we had a big up day. This is the first close above the previous bar's close after reaching trailing stop level. I exited half the position and locked in a gain of 1.95%. The next day continued up very, very strong, but did not close above my close of 739.70, kept me in the trade. Next day down, did hit a profit target to the downside. Next day, way down, hit multiple profit targets on this move down, right? So now I'm starting to run out of shares because I've taken half off and I've taken many profit targets. So now really the stress is kind of off the trade. Next day we gap up, next day we gap down, where I did take some more profit targets here. And then from there, we've kind of moved back up. So the remaining shares that I have on this trade are still up 1.64%. But you can see when the market was down here near its lows, I was taking profits into that opportunity. And not surprising, take a look. Where did the bounce come from? In the bullish order block. And I placed a custom level here where if I had not been short the Qs, I would have want to have gotten long. You can see the green bar, that was my custom level. Look at this. On Wednesday, I think we literally got to 1 or 2 pennies away from that level, and then it bounced. So, these custom levels and these order blocks are very strong. They don't always get perfect to the penny like this one, but this one did. So, right now I think the Qs are going to bounce. It's going to be difficult to get above this order block, and I think it will be difficult to get below this bullish order block. So difficult to get above the bearish one, difficult to get below the bullish one. So, if I had to guess, and it's just a guess, but I think we're going to stay in the range of from about here up to here, but who knows, something could happen and we could blast off up or we could head back down, who knows. But remaining shares on this short up 1.64%. Netflix. All right, so Netflix, I did get long Netflix on the 1st of July at 73.93. Why did it get long here? Well, we had a close under 30 the previous day and a close over the 30 the very next day. So that by itself is a deep dip buy signal. In addition, we created a V2, bar 1, bar 2, bar 3. 2 goes under bar 1's low, 3 closes above bar 1's close. So I got long here, 73.79. Now, I position sized, I placed my end of bar stop, I placed my emergency stop 2 ATRs below. My end of bar stop is halfway of the washout bar of the V2. That's why I have this red line right here. This is my end of bar stop. So I entered 73.79. I placed my trailing stop level 1.5 ATRs above. The next day took off like a rocket ship, which was great. Hit multiple profits into that move up. Also got to trailing stop level. Then we moved sideways for a couple days, and then here on the 8th was my first close below a previous bar's low. After reaching trailing stop level, what am I supposed to do? Take off half my position, which I did for a gain of 2.49%. Now I still have half my position. And going forward, you can see on Friday we got very close to my end of bar stop, and that's exactly where we bounced. So if we move, if Monday, for example, we close below the 72.40 level halfway, I'll simply exit the trade. That's it. If it holds above here, I'll stay in the trade and continue to take partial profits if it allows me. By the way, earnings are coming up here on the 16th. I never hold through earnings. So regardless, I mean, if I am still in the trade by the 16th, I will exit, whether I'm up, down, sideways, it doesn't matter. All right. So the remaining shares that I have on this particular trade are down slightly, 0.57%, but you can see, really glad that I took half off when the signal told me to. And of course, am I glad I sold into that strength when I had it? Yeah, of course. That's the reason I do it. But the remaining shares on this trade down 0.57%. NVIDIA. NVIDIA has been a monster trade. It's been a fantastic trade. I did take NVIDIA here on the 7th of July at 196.93. Why? Two signals. We had a rejection of the bottom of the order block, the green box. You can see we were below the green box and then we closed back in the green box. That's the primary signal. In addition to that, we created a V1. Here is bar 1, here is bar 2. Bar 2 goes below bar 1's low, closes above bar 1's close. And again, entered at 196.93, position size, placed my emergency stop 2 ATRs below. My end of bar stop is simply a close below this order block. So I'm very close to that level, giving myself a good risk to reward. The next day, we opened up below the order block, but I wait for the end of the day to make my decisions, and we had a huge move up where, of course, I was able to take partial profits into that move. The next day was sideways. Well, it was down a little. Um, uh, so no profit targets. And then Friday had a huge day up 4.03%. Of course, I sold partial profits into that strength. Obviously, we got to trailing stop level, so now I'm in trailing stop mode. Again, all that means is in the future, if I have a close below previous bar's low, I'm going to exit half of my position. But the remaining shares that I have up 6.7% on this trade. And again, waited for the confluence of signals. My stop was a close below the order block. I have my worst case scenario down here if I'm wrong. Took advantage of selling into the strength. And now that I'm in trailing stop mode, if I get a close below previous bar's low, I'm going to get out of half. But very nice trade, up 6.7% on the remaining shares. CCJ. Okay, I entered CCJ here on the 8th of July at 94.81. Why? Well, You see the green box. This is a bullish order block. I like to have key levels within key levels, and on this particular trade, the key level was this 300-day moving average. So this is a combination of a deep dip buy and a rejection of the order block. On this particular day, we rejected the key level of the 300 within the key level of the bullish order block and took the trade here, 94.81. High position size based upon volatility and my account size. I placed my emergency stop 2 ATRs below. My end of bar stop is a close below this 300-day moving average. I placed my trailing stop level 1.5 ATRs above. Next day we moved up where I did hit one profit target. And then on Friday we closed up a little. So this particular trade is doing okay. I mean, it's up a little. It's up 1.3%, but not to trailing stop level yet. So I'm, as long as it stays above this 300-day moving average, I'm bullish. As long as it stays above this 300, I'm staying in the trade. And if the market moves up, I will take advantage of that by selling into strength with partial profits. If I get to trailing stop mode, of course, I'll go into trailing stop mode. If Monday it closes below this 300, I'm just simply out of the trade. That's it. I can't control any of this, but I can control what I do. I have to have if-then statements. If it does this, then I'm going to do that. If it does that, then I'm going to do this. And that's it. I wish I could control the market. I'm sure everyone else does too, but you have to create a plan and you have to have rules that tell you if it does this, I'm going to do that. If it does that, I'm going to do this, and give your, wait for confluences of signals, have good risk to reward ratios, and that's about all you can do. All right. So, remaining shares on CCJ up 1.3%. All right. I did take a trade on Friday, BIIB, and again, surprise, surprise, it involves an order block, right? So here's our order block. And within the order block, I'm looking for a key level. Well, the key level in this case is the 50-day moving average. It's the gray line. Could have taken the trade on Thursday when it rejected the 50. I didn't see it, but I saw it on Friday. And so on Friday, we of course rejected the 50, meaning we were below it during the day. We closed above it. So that's one thing. But in addition to that, we also had a V1, bar 1, bar 2. Bar 2 goes under bar 1's low. Bar 3 closes above bar 1's close. Perfect. It just adds bonus points to the trade. So I entered here 199.12. I placed my emergency stop 2 ATRs below. My end of bar stop is simply a close below that 50-day moving average, below that gray line. If Monday, if it closed below, I'm just out. I was just wrong, right? But it has shown me 2 days in a row that there were no more sellers underneath this level. Doesn't mean there won't be on Monday, but I have to take what I can get. And the market so far said, yeah, we don't really want to sell under here, so maybe we go back up. I don't know. We'll see. And then I have my 1.5 ATR trailing stop loss. So this one is completely, basically break even because I just bought that. So those are the trades. It's been a really, really good trading week. I have a lot of positions, but they're not full positions because as I take them, I'm taking partial profits. I've gone into trailing stop mode with some, so I sold half. So yeah, I mean all the positions up this week except for one. So we'll just see what happens with next week. So before we get into what I'm looking at next week for the potentials for next week, let's just talk a little bit about trading psychology because it's so important. This is from Steve Burns, friend of mine, really great trader, really great author, prolific author. I think he's written, 41 trading books, and I studied with him years ago, learned a lot from Steve. And follow Steve at @SJosephBurns on X. He posts all the time. He posts really good things and a super smart guy, really great trader. So when he posts things, I read them and I take them in. And so let's see what Steve had to say today. The secret to winning in the markets is not being the smartest trader or investor. It is being one of the most disciplined. And It's so true, everybody. You know, when I have students come to me, if for some reason in the conversation they're, I don't know, like they went to Yale or Harvard, or they're a really successful business owner, I'm always a little concerned because, in general, they have a pretty high IQ. They're pretty smart. Um, the reason that concerns me is that, in my opinion, in my experience, the smarter you are, the more of a difficult time you're going to have with trading, because you're going to try to figure stuff out based upon the news or what you read. And it's a liability. Now, if somebody comes to me like straight out of the military, they're very disciplined, follow orders. I honestly, if I had to bet on which one would be a successful trader, it would be the young lady or the young man from the military that doesn't think that they know everything. Really, because I know they are going to follow their processes without overthinking them. I guess that's what I'm saying. So I think having a high IQ in trading is a liability and something you have to overcome. So, it doesn't mean if you're very smart, you can't be a successful trader, but the tendency is that you're going to want to figure stuff out and not follow your rules. So it's all about following your rules and being disciplined. Just like Steve says, the secret to winning in the markets is not being the smartest trader or investor. It is being one of the most disciplined. So to bring this full circle, everybody, if you want to be a successful trader, throw all your high IQ-ness out in the garbage and be disciplined and follow your rules. That's really what it comes down to. I know it's fun to second guess the market, and then when you're right, you're like, aha, I knew it. It's all BS, really. It's all BS. So, just down back to back to basics. If you're struggling with trading, be honest with yourself and ask yourself, am I really being disciplined and following the rules, or am I making audible calls and changing stuff right in the middle? Just don't do it, everybody. Just don't do it. You don't have to be the smartest trader or investor. Just be disciplined one. All right. So anyway, I hope that helps everybody. And thank you very much, Steve. And please follow Steve at S. Joseph Burns. All right. So, like I mentioned last night, I went down through my entire master watch list and I have identified 7 particular markets, symbols for next week that I'm looking at. Now, these are not where they need to be yet, but they are potentially within striking distance. And so we're going to go down and I'm going to show you exactly the levels that I'm looking for. I do want to point out, I point this out every week. So here I have 7. Is it possible on Monday that all 7 could trigger? 100% yes. Does that mean I would take all 7 positions? 100% no. I only take 1 position per day. Even if all 7 of these are perfect, I'm going to have to find the one that's more perfect than the others. And the way that I do this is that I give a quality score to each setup. Just to be very simple, if it has 1 signal, I give it a score of 1. If it has 2 signals, I give it a score of 2, and so forth. And I generally am going to pick the one that has the highest score. However, when it comes to risk to reward, maybe I have a score of 5, but it has a horrible risk to reward ratio. Maybe I'm going to have to pass on that trade, right? Because the initial risk to reward is very important, or I'll have to deduct some points because it has a bad risk to reward ratio. So I also look at the longer term chart. So if I'm trading the daily, I like to look at the weekly and see if I can find something, glean something from the weekly. Maybe on the daily they all look the same, but on the weekly, maybe one of those on the weeks is at the 200-week moving average, right? So that would give an extra bonus point for that particular trade. So I also like to look at relative strength. If the market was down, across the board, but this particular stock was up, then I want to give that a little extra bonus point because it was strong in the face of weakness in the overall general market. So really the devil's kind of in the details with how to pick if you have multiple candidates, how to pick the best one. And so I spend a lot of time and energy every day if I have multiple signals looking back and forth which one's the best one. And this is how I trade, and this is how I teach my students. And if I could just put in a real quick plug for a couple minutes just to explain what I do. I am a professional trader. I've been trading for over 30 years, both stock and options. But I teach people around the world how to trade. I've taught people in many different countries, and I've been teaching for over a decade now. And I love to teach. And I have a one-on-one course. It's just me and the student, and we spend 2 hours a week together for 10 weeks, so a total of 20 hours. And I teach you all of my strategies, all of my rules, all the setups, and we're together 2 hours every single week, which by itself is a real advantage because we're together and watching the markets move, up, down, sideways, whatever. But I just think the very best way to learn anything is to do it one-on-one with your coach or your mentor. And like I said, I love to teach. I'd love to have you as my student. I'll teach you everything I know. And when you're done, you will have a skill really that you can use the rest of your life. So if you're interested, please send me an email. The email is in the link of the YouTube video. The course does cost $2,000, but it's money well spent. It's a skill that you'll be able to learn the rest of your life. And I will, like I said, I'll teach you everything I know, and I give every lesson 110%. Now, if you like online courses, I have an option for you. I've talked about deep dip buy setups today during the podcast, and I have a great course on udemy.com. I've sold so many of those around the world. The link is in the description, and it's very affordable. It's between $30 and $50, and it's 9.5 hours of video where I teach you step by step how to trade the deep dip buy approach. Now, in the one-on-one course, of course, I teach you all the different approaches. But anyway, it's a good place to start, less expensive. But of course, the one-on-one course I think is obviously the best because we're going to work together, answer all your questions, and just teach you all the rules, all the setups, everything. Do a lot of simulation trading as well. So if you're interested, I would love to hear from you. Just send me a message. So anyway, thank you for putting in my little plug there. And let's get on to the potential trades for next week. So here's Amazon. Okay, so Amazon has an order block here, right? Why order block? Swing low, swing high, lower swing low, market structure change. Once I have the market structure change, I'm waiting for a pullback into the smart money area. Ideally, I would like to have some key major moving averages, deep dip buy averages within the order block, and there are two. The purple line here, if you can see that, that is the 250-day moving average. That's a key level just by itself, but it's a more of a key level because it's within the smart money area. Also, the orange line is the 300-day moving average. So right now, Amazon is, could it get here by the end of the week? Yeah, of course it could. I don't know if it's likely, but it certainly could. And if it does, then I would be looking to potentially enter. So what I'm looking for is a rejection of, first of all, would be the 250-day moving average. The 250 at this moment is 232.22. And if it rejected that, then if I took the trade, I would use a close back below the 250 as my end of bar stop. If it moves lower and gets to the 300-day moving average, right now the 300-day moving average is 228.27. If it did come down and reject this moving average, the 300, then I would potentially take the trade as well, and my stop would be closed back below the 300-day moving average. You can see the last time it tested the 300-day moving average, it tested it 2 times, and it respected it. So we'll see. So a rejection of the 250-day moving average in the order block or a rejection of the 300-day moving average in the order block would be potential trade for me on Amazon. And if Amazon doesn't get down there, then fine. I don't take the trade, right? Don't force it. Let the trade come to you. Look at the trade and say, okay, this would be ideal. This would be ideal, rejection of 250, or this would be ideal, rejection of the 300. And if it happens, okay, then consider taking the trade because it got to where you want it. If it doesn't happen, just let it go and don't force it. Boeing. All right, very similar. We have an order block. Swing low, swing high, lower swing low, market structure change. After market structure changes, I'm waiting for pullbacks to the smart money area. And right now we have two levels that are within striking distance. We have the 200-day moving average, which is 218.64. And below that, we have the 300-day moving average, which is at 217.83. Again, a rejection of the 200 or a rejection of the 300 by itself is a legitimate entry, but this is an improved version of that because these major moving average are within the smart money area. Remember, key level within key level. So anyway, I'll be watching Boeing very carefully next week to look for either a rejection of the 200 or a rejection of the 300. Excuse me. Did I say 250? Rejection of the 200 or a rejection of the 300. Walt Disney. Well, well. Things were looking up for Disney, and now they're looking down for Disney. However, we are kind of coming into an interesting area. Look back here on the 27th of June. See how I've highlighted it in blue? That's a bullish abandoned baby. We gap down, immediately followed by a gap up. More times than not, when that happens, you will see a move up, which happened. However, when you have an abandoned baby, the key level to that abandoned baby is the high of the abandoned baby, the high of the bar that's in the blue box. What's the high there? 93.47. That's a key level. If the market moves back and tests the high of that abandoned baby, 93.47, I would consider getting in the trade because, I mean, we are very close to that. One or two more days down, we could get down here. And by the way, this isn't just an abandoned baby. This is an order block as well. But what I'm looking for is a rejection of the high of the abandoned baby, 93.47. If that happens, then in this particular case, very likely I will place a 2 ATR stop and a 4 ATR profit target, and I'll just let it run. And I'll either lose 1% on my account or I'll make 2% on my account. But based upon the historical movements of these abandoned babies, I'm probably more likely to make 2% than I am to lose 1%. And that's what trading is about. It's about probabilities, right? And if you look at Disney just in general, I mean, it's down quite a bit. It doesn't mean it can't go down further, but I mean, it's pretty oversold, and we are coming to a key level. So anyway, rejection of the high of the order, or the rejection of the high of the order block, which is also a rejection of the high of the abandoned baby, 93.47. I would consider getting long there. 2 ATR stop, 4 ATR profit target. In addition, from a MACD perspective, you can see the low we have over here, deep red. Now we are lower here than there. These bars not as deep. So double bottom bullish MACD divergence as forming as well. So that's what I'm looking for on Disney. FedEx, FDX. All right. We have an order block from the past in the green. We have a 250-day moving average that's living inside that order block. This makes it pretty simple. If this comes down, rejects the 250-day moving average, which is 299.66, If it moves down next week and rejects that level, I would seriously consider taking the trade, and my stop would be a close back below the 250-day moving average. In addition to the order block and the major moving average, we have a double bottom bullish divergence. Look at the low here, the deep red MACDs. We rally, we go to green. We are certainly lower here than we are over here. At this point, we don't even have any red. This is an even stronger technical version of the MACD because this is a double bottom MACD divergence with a missing right shoulder, meaning it does not even have any red MACD. So this is really indicating that we're running out of sellers. And if you run out of sellers, the market tends to go up more than, that's what it's implying, that you're running out of sellers. If you run out in sellers, you can kind of expect to bounce. Of course, it doesn't always happen, right? That's why we have to have our stops. But anyway, that's what I'm looking for in the context of this double bottom bullish MACD divergence with the missing right shoulder coming into a key level of an order block, smart money area, and a key level of a 250-day moving average. That's what I'm waiting for. Now, it could just bounce from here and I'd miss it. That's fine. I don't care. I don't want to get into a trade unless it does exactly what I want it to do. And what I want it to do right now is reject the 250-day moving average, and I'll use that as my stop. Russell 2000, IWM. Okay, this is an order block. It's a higher order block. And what I'm looking for, I've talked about this for a couple weeks. What I'm looking for is, remember, we're looking for key level within key level. The first key level would be the 50-day moving average. This is the gray line, okay, near the top of the order block. If we rejected that, I would consider taking that trade. I've also put a custom level in here, 284.30. What's that about? That's about this bar back here. This is a V1. I know that there's some inherent support on a V1 at about halfway. So that's why I put this level. So I'm looking for two levels, either a rejection of the 50-day moving average, 288.62, or a rejection of this custom level halfway of the V1 inside the order block, 284.30. And both of those levels, if I were to take them from those levels and they were to close below, that would be my exit point. Bonds, TLT. Well, bonds have really sold off here in the last few weeks, but there's two key levels right now that I'm looking at. The first one, back here to the 19th of May, I circled this bar in blue. Why? Abandoned baby. Gap down, gap up. The tendency when that happens is for the price to move up. Did that happen? It certainly did. Where's the key level on an abandoned baby? The high of the abandoned baby. That's why I have this level, this custom level here, 83.25. Okay, and this is a key level within a longer term order block. That's why this is all green. In addition to that, if you look at the RSI is 37.85. Well, an under 30 over 30 is a legitimate entry signal from a deep dip buy perspective. And if that happens, if you have a rejection under 30 over 30, again, it's happening inside this order block, the longer term green order block. So there's a lot of key levels there. We haven't hit any yet, but just to reiterate, a rejection of the high of the baby at 83.25 would be legit. If that happens, I'll probably do a 2 ATR stop, 4 ATR profit target. If that doesn't happen, but we reject the 30 RSI, then I'll just do it the regular way with end of bar stops, emergency stops, trailing stop level. But that could happen before it got to the custom level, the under 30 over 30, because we're already at 37.85. So anyway, that's what I'm looking for on TLT. And then last but not least is XOM. This one's pretty easy. We have an order block from the past. We have a major moving average inside the order block. It's living in the order block. Those are the setups that I want. So this one, essentially, if we get a rejection of the 200-day moving average, which is the black line, that's 135 even today. that 200-day moving average is living inside the order block. So next week, if we come down and we reject that 200-day, we either bounce at the 200, we close under, then close back over, or we have an intraday rejection of the 200, I would consider definitely taking that trade. My stop would be closed back below the 200-day moving average. But the key, again, not just that because it's at the 200, because it's at the 200 and the 200 is living inside the order block. All right. So listen, if you have any questions about anything that I mentioned today, please put them in the comment section. I'll do my best to get back to you and answer your questions. Again, if I can help you with your trading, I have a couple options. I teach the 20-hour one-on-one course. I also have the link in the description for the Deep Dip Buy stock trading online course. I also do private consulting. Have consulted with at the hedge fund level as far as my process and what I do. I do a lot with options, but I can help you in any way with your trading. Be glad to, love to teach people things about trading and help them with the trading. So please reach out to me. Be happy to talk to you and happy to work with you. So again, appreciate you being here, everybody. I always like to leave off with, listen, if you have the opportunity that you can go out and maybe do an act of kindness for a person, just help them out. Just, they drop something, pick it up. We always like when somebody does an act of kindness for me, for us, when we're not expecting it. Why not return the favor? It just would make the world a lot better place. I'm a big animal lover. If you have the opportunity to, help an animal out along the way, please do it. They appreciate act of kindness just like we do. So, I have a small little platform, but I at least like to put that out every week. And I've actually had many people write me and say, Greg, I helped this person out or I helped that animal out because I heard it on the podcast. It just, fills my heart up, and I'm really glad. So anyway, I appreciate you being here, everybody. I hope you have a good rest of your week, your weekend, and get some rest, enjoy, and be careful with your trading, be smart, and follow your rules. Yeah, and God willing, hopefully I will see you next week. So thanks a lot, everybody. Appreciate you being here. Have a nice rest of your weekend. Thanks a lot. Bye-bye.
U.S. government required disclaimer. Stock, options, futures, and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.